Welcome. Today's Thursday, June 7th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your daily five. The first thing I wanted to do is kind of address the elephant in the room. Are we at a market bottom? Chart number one takes a look at the textbook bullish setup of any security. In this case, we've identified what we'll call a mystery stock in the market that has set up in what we believe to be is really just the perfect bearish to bullish trend reversal setup. And we've kind of identified it with a couple of markers here. Number one, we've got a classic patterned base formation that's resolved above key resistance, as we can see. There's several key moving averages that are turning up. We've used the 50-day and the 200-day moving averages just to kind of show the change in trend underway. And it's accentuated by the fact that the faster of the two moving averages has crossed above the slower. And so with the 50 now above the 200-day moving average, and the market having resolved, or I should say the stock having resolved above its base formation here, we can come to the conclusion that we are in fact in a new uptrend. And the real question is, where in that process are we? So we've attached what we believe appears to be a new impulsive Elliott wave pattern that's emerging at multiple degrees of trend. We've counted a 1, 2 at what we'll call primary degree. We've counted a second 1, 2 that we'll call intermediate degree. And then we've counted a final 1, 2 that we'll call minute degree. And so the next big move here would be a big move to the upside. In fact, a new recovery high in this stock would confirm that a third of a third wave advance is underway. So enough already. What's the ticker on this stock? We're going to get to that. That's chart number 5. So let's move to chart number 2, just to kind of take a look at what I believe to be the biggest mystery in the market at this point, the US dollar index. This extraordinary advance that we've seen in the DXY really began last fall. It's one of the most puzzling sort of questions that has market participants, analysts, economists, all kind of trying to figure out what is driving this. Some have pointed to the war in Eastern Europe as being the reason. The strength of the ruble, though, doesn't really, line up with what's going on in the dollar here. And, the other problem is that it doesn't explain the collapse in the JPY, which has little to do with, a war in Eastern Europe. Others have pointed to the shutdowns that we've seen in China that have really caused the Chinese economy to slow unexpectedly and dramatically. But the Chinese yuan does not float freely against the US dollar. So that doesn't make a lot of sense either. The US dollar has really long been considered to be the ultimate safe haven asset. And the rise in the Dixie actually appears to be signaling something of great importance right now. The real question is what? And so we're going to try and answer it in the next 3 charts, which are going to be charts 3A, B, and C. So let's start with chart 3A. And this is really looking at real GDP growth, which has been in utter collapse since the end of last year. First quarter 22 real GDP was just revised with its final print at minus 1.6%. That compares to a 7% annualized growth rate in the fourth quarter of 2021. Now, also, according to the Atlanta Fed's GDP Nowcast, real GDP growth remains exceptionally weak, and the second quarter annualized rate is now looking like it could come in at negative 2.1%, so even worse than the first quarter. So in our view at this point, the real risk, economically speaking, is that we should prepare for some incremental downside in terms of quarterly GDP. And we're looking for a contraction in the second quarter. Now, as most will already know, as a rule of thumb, 2 consecutive quarters of shrinking economic output has long been associated with every past recession. So, the question is, are we going to be in a recession? I think the real question is, are we already in recession? Chart 3B looks at one of the key reasons here. And in our view, it's core inflation rising. Many on the street have been vocally calling for headline inflation data to peak, and they may very well be right. But quietly, core inflation has been creeping higher. And, a lot of people aren't aware of the fact that, while the Federal Reserve Board has adopted the core PCE, personal consumption expenditure rather, as their preferred measure of core inflation, the 9 Federal Reserve banks have each developed their own unique formulas for measuring core inflation. And, when we take those together with an aggregated reading, we've actually seen core inflation move up over 50 basis points in the month of May. Now, we're going to get another report in the not too distant future, about a week from now, on headline CPI. And if that number comes in below expectations, as many have been signaling, it could be positive for the markets in the short term. But our concern is that, with this, kind of under the hood or behind the scenes sort of increases in the core contributors to CPI, that it might be insignificant whether or not this headline number comes in below expectations. Because importantly, none of these calculations on the core inflation rate includes energy or agricultural commodity prices in them, or any of the high frequency data for that matter. It's really the sticky components of inflation that they're looking at. And so with core inflation now hovering about 340 basis points above the 2% target that the Fed has as their long-standing target, we believe that the real risk here is for a rising rate environment. And that moves us to chart 3C, which looks at the 10-year Treasury yield. Now, despite the collapse in real GDP growth in the first half of the year, the 10-year yield broke out to its highest level since 2018, reaching 3.49% before its recent pullback. And more importantly, in our view, is the fact that the 10-year yield posted its first daily, weekly, monthly, and quarterly closes above what was heretofore a prevailing 40-year trend resistance barrier. The breach of this level, or breakout above that level, occurred as inflation data surged, but it's suggesting that we're in a new regime of higher interest rates, and that if a new regime of higher interest rates is beginning, with an initial breakout like this, we can count from a technical perspective a measured move to approximately 6%. So the chart implies 2 potential paths to get there. Now, the first path is a direct path, and that's the dotted line. That's probably not our first case. It's not our base case. That would suggest that inflation continues to come in super hot on a headline basis, and the market overreacts to that and runs straight up to 6% over, say, the next 12, maybe 18 months. More likely, we could get another test of that high that was just put in place around 3.5% before we get a deeper pullback, as the cooling of the economy that's evident in the GDP data brings everybody's attention to the best asset to own in a recession. That is U.S. Treasury bonds, and that could bring yields all the way back down to, say, around 2% or so, which is where we would expect the 36-month exponential moving average to come into play as support before we see an ultimate rise to around 6%. Having said that, we want to take a look at what's going on in the bond market internally. So chart 4 addresses what we would call the disparity between the MOVE index and the VIX. What's the MOVE index? That's the market option volatility estimate for Treasury bonds. So the MOVE index is to the bond market what the VIX is to the stock market. And the question is, what does the bond market know that the stock market doesn't? Well, historically, these series have had a very strong positive correlation. When the MOVE index rises, the VIX index rises, almost in perfect harmony. But in recent weeks, we've seen that correlation break down substantially. And the nearly flat performance of the VIX in the face of this epic spike that we've been able to observe in the MOVE index suggests that one of these markets is wrong. Okay, it's either the MOVE index or the bond market or the stock market and the VIX have completely estimated the risk that's in the markets at this point in time. And so our view is this: the bond market is known as the smart money. It's not known as the smart money for nothing. There are wiser and more vigilant investors in the bond market, and a lot more money in the bond market than there is in the stock market. And while speculation exists in the bond market, it's nothing to the extent that it is in the stock market. And so, we believe that at some point in time, these two indexes are going to converge again. And most likely, in our opinion, it will be the VIX catching up with the MOVE. But let's get back to our initial discussion point. Chart 5 takes a look again at that, textbook bullish setup. And, the question that's been asked in the marketplace is, has the stock market bottomed? Okay. Well, I believe that this is a textbook view of what the stock market would look like if in fact it had bottomed. And the real question is that what the stock market looks like? Well, let me tell you what this mystery stock is. Let's flip to chart 5B. And what we're looking at right now is the exact same chart that we were just looking at. The problem is chart 5A was inverted. It was the S&P 500 inverted. What we're looking at right now is the actual S&P 500. And in fact, it is a textbook bearish setup, not a bullish setup. It is the exact opposite of what you would expect to see at a bottom. And so the answer to the question in our mind is that it's a definitive no. The S&P 500, the stock market, has not bottomed. And in fact, the 24.5% peak to trough decline shows all the evidence that what we look for of a top, not a bottom, but a much larger degree top than we need to normally be concerned with. In this particular case, we've seen a breach of key moving averages, key support levels, coupled with the bearish inflection below the neckline of a classic pattern top formation of the head and shoulders variety. We believe that breakdown below 4,200 projects a measured move to a minimum target of 3,500. Now that 3,500 target coincides with a 50% retracement of the advance off the March 2020 low. It coincides with the 200-week simple moving average. It also coincides with an open chart gap, as well as two prior weekly closing highs of significance back in 2020. And, our biggest concern is that it's such an obvious target for support that it might not actually hold. And in fact, our biggest concern is that we just cut right through it like a hot knife through butter and head down to the next level of support, which in our mind would be our stretch target of around S&P 3,200, which would mark the 61.8% retracement. At this point, only a sustained recovery above key resistance at S&P 4,200 would call this immediate bear case for stocks into question. With that said, I want to caution investors at this point in time to use any strength that the market's giving us this summer as an opportunity to sell stocks, raise cash, and position for a relatively severe recession, if not stagflation going forward. That's all we had to say today. And with that, we'd like to thank you very much for joining us. And if you'd like to follow up with us in any way or take a look at our work and get more information, you can find us on Twitter at alpha_insights. We're also on LinkedIn, or you can go directly to our website at www.jwhinvestment.com. Take a look at our free newsletter, which just came out last Saturday, so it's fresh with all the details of our view on the market and many other things. Thanks again for watching, and good luck trading.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.